Welcome back to Rockstock Channel. It is Tuesday, September 24th. Last week, I had the opportunity to revisit the North American lithium mine in Quebec, operated by Sayona Mining in partnership with Piedmont Lithium. It was nearly 2 years since my first visit in November 2022, and a great deal has changed. The mine and spodumene concentration plant, video of which will follow this introduction, is now in full operation, having ramped up last month to nameplate capacity. The company now also has a new full-time CEO, Lucas Dow, who Rodney and I are interviewing today. Lucas follows the excellent work James Brown, the godfather of spodumene, undertook to recommission this brownfield operation over the past year, and of Brett Lynch, Sayona's visionary leader, who secured not only North American lithium, but also Sayona's world-class Moblan deposit, for which the market is attributing zero value, in my opinion. For disclosure purposes, you should know that Rodney and I are not strategic advisors to, nor hold equity interests in Sayona Mining, but we have been advisors to and invested in Sayona's JV partner, Piedmont Lithium, for many years. However, Sayona has commissioned us to prepare this video to help educate their nearly 50,000 retail shareholders, as well as the broader lithium industry, about developments at the company and its widely misunderstood North American lithium operations. As a reminder, Rodney and I are not financial advisors. This video is for information purposes only, and nothing said here should be considered investment advice. Please do your own research and read the disclaimer at the end of this video. Note that a written summary of this interview will be published in the next edition of RK Equity's Lithium-Ion Bull. Please register your email at rkequity.com if you'd like to receive this newsletter directly to your email box. And please make sure to like this video, subscribe to Rockstock Channel, and leave a question or comment below. What do you think of Lucas and the Sayona team? What other companies or niche metals might you be interested to hear from on Rockstock Channel in the future? You could also email us your thoughts at rockstockchannel@rkequity.com. And also, if you'd like some research on Sayona Mining from one of their analysts at that same email address, you could also tag Rodney or me at RodneyHooper13 and at Lithium-Ion Bull. As always, I'll introduce Sayona Mining with a brief synopsis of key company attributes. Sayona trades on the Australian Stock Exchange, ticker symbol SYA. It also trades on the OTC, SYXAF. The current share price is about 2.6 Australian cents, down 63% from where it started the year at 7 cents. Sayona's current market cap is about 267 million Australian dollars, equivalent to about 182 million US dollars. As of the end of the June quarter, Sayona had 91 million Aussie in the bank, and importantly, the company has zero debt. Sayona's most recent equity raise was July of last year, led by Petra Capital, which raised 200 million Australian dollars at 18 cents through a regular equity placement in Australia. This followed a $55 million placing in March of last year of flow-through financing, 31.5 cents. For listeners unaware of flow-through funding, it is a special program offered in Canada enabling companies to raise capital at substantial premiums. In Sayona's case, a 40% premium to its stock price last March. However, all the proceeds need to be spent on exploration within Canada and within 12 months. Sayona has used last year's flow-through funding to substantially increase the resource at both North American Lithium and Moblan, as you'll hear about later. Sayona has sell-side analyst coverage from Petra's Andrew Harrington, as well as Canaccord, Quarry, Desjardins, and Clarksons. You could follow Sayona on X at Sayona Mining, and their website is sayonamining.com.au. And with that intro, welcome Lucas Dow to Rockstock Channel. Why don't you start with a bit of your background and what attracted you to become CEO of Sayona 10 weeks ago? And then Rodney and I will get into some further questions.
Thanks, Howard and Rodney. Great to be with you. So by way of background, mining engineer by training, worked across a host of different geographies and commodities, including copper, silver, lead, zinc, thermal coal, met coal, manganese, Also had some exposure to gold, platinum, tin and some bauxite as well. I had a pretty traditional career development pathway, started out in operational engineering roles into supervisory roles like drill and blast foreman, and then onto mining manager roles, processing manager roles, and then into general manager roles. I have held a number of CEO roles, including CEO and asset president for the BHP Mitsubishi joint venture, BMA, and more recently was CEO and country head for Adani Australia and had carriage for the Carmichael project, which was a US $2 billion open cut processing 200-kilometre greenfield rail project and above rail operating business. In addition to that, I also had the solar business on the renewables front and a bulk port facility doing sort of in excess of 30 million tonnes a year. So it's really against that backdrop that that attracted me to Sayona and has actually got me pretty excited about what we're going to be able to do with the quality of the assets that we've got within the Sayona portfolio.
Okay, great. Thanks, Lucas. Good to have you on. Recently, I see that the NAL resource has been expanded to just under 88 million tonnes, 1.13% with further upside. How does this translate into value for shareholders or lengthening of the mine life?
Yeah, thanks, Rodney. As Howard described at the top of his introduction, we put that flow through share funding to work, and it's resulted in a significant increase at NAL, and we've now got over 88 million tonnes of resource there. The interesting and obvious aspect that it now gives us is obviously an extended mine life, but I think more interestingly, the opportunity that we've now got, and as we think about converting that to reserves, is the prospect and the opportunity to be able to actually expand NAL. In short, NAL is currently constrained by the processing capacity. The mine's readily expandable. So one of the options that we've got is clearly being able to duplicate the existing processing facility and be able to increase the output at NAL. And if you think about it from a perspective of a de-risked brownfield expansion, clearly the permitting pathways is much simpler than a greenfield project. We've got the existing utilities and infrastructure there. We've got an established workforce, close to Amos and also Val-d'Or. So really, there's a lot of elements going forward, and we think is going to make it very attractive as a brownfield expansion opportunity. So clearly, extended mine life's one outcome, but the area that we're very excited about studying is the opportunity to be able to expand NAL and then obviously increase spodumene output through NAL.
And just on that note, the production target for the year has been increasing, which is great over time. It now stands at about 190 to 210,000 tonnes for the year. Do you feel like NAL has reached the sort of perfect trade-off between grade and production volume?
Yeah, right now I think we've still got some more tinkering to do, and we think we've got a bit more runway ahead of us. And just to give you a sense, you'd referenced that we'd hit just under 50,000 tonnes for the last quarter, which would put us on an annualised run rate of just under 200,000 tonnes. So clearly there's a real opportunity for us to be able to continue to drive that. And just to put that in context, we saw mill utilisation increase quarter on quarter from 73% through to 83%. And we've now been delivering months in excess of 90% of mill utilisation. So we've got some increased runway in terms of throughput. Recoveries have been in the order of 68 to 69%. And as you guys have acknowledged, that's certainly sort of leading edge in terms of recoveries for flotation circuit for spodumene. So we're in pretty good shape there, but we've still got more to do. And importantly, there's a real opportunity for us to be able to drive volume up and continue to drive our unit costs down, which is obviously a key focus for us given this low price environment.
And just on that, Lucas, where are costs sitting these days?
So we're out with guidance of in the order of $1,150 to $1,300 Australian FOB, which would put us around $770 on an FOB basis. I think importantly, there's still some further upside for us to be able to reduce costs. And just one illustration of that is historically cargoes have gone out through the Port of Quebec in 15,000 tonne lots. We've got an opportunity in working with our joint venture partner, Piedmont, to be able to club those cargoes into larger shipments, so in the order of 30,000 tonnes. and that represents a freight saving in the order of around $50 US a ton. So, we expect to be able to continue to drive those unit costs down. What people can expect from us is to see those unit costs continue to trend down and drift down throughout the subsequent quarters in FY25. So certainly in the back half, we expect to be in a strong position. And really, our objective is to get ourselves into a break-even position so that we can ride out this low price environment, such that when prices turn, we're perfectly positioned to be able to really come roaring back and be able to throw off some cash.
I just want to dig in a little bit to that a second. So because you talk in Aussie terms, but then you talked in dollar terms. You said 770 FOB.
US. Yeah, that's
US
right.
is the guidance. And you think that by grouping shipments with Piedmont, you could reduce that by another $50 to maybe 720, although that's not your full guidance. Is that accurate?
Yeah, they're the opportunities that we've got on hand. There's also a number of other aspects that we're looking at around mining services contract renegotiation, so forth, Howard. So really the key element is that we're certainly not sitting there idly. We're going to continue to really get after our costs and get ourselves into the best possible cost position that we can.
During the site visit, now that I guess you're at 1 month, full capacity, and you've had that ramp up, everything that I heard during the site visit was optimization from Sylvain and the team. Anywhere you can kind of pull out any cost was very much, I heard a lot. So basically $50 on the freight savings, and you just said, I'm sorry, optimizing on
so increased runtime. So there's opportunity. Yeah, so we can see that runtime, as I said, we'd seen from quarter 3 to quarter 4 in financial year 24, it increased from 73 to 83%. We've had months now in excess of 90%. So there's a bit more runway in terms of being able to get additional volume out, which will obviously help to improve our unit cost position as well. So we're looking to work both sides of the equation in terms of both absolute spend, but also getting our volume up through the mill.
And when you're saying you're trying to be break even, that's based on a 770 FOB. So you think you can be selling for at least that price with a 12-month time frame?
I think there's two elements there, Howard. I think we're doing everything we can to be able to drive our costs a little lower than that. In addition, there's obviously opportunity with the forward curve in contango to be able to lock in some downside protection as well. So there are elements that we've got available to be able to work through this. So it's very much a case for us now, just focusing on the safe delivery of volume and reducing our unit costs.
Okay, great. So one of the things I noticed, Lucas, was there was a meaningful reduction in mining dilution over the last while compared to previous production periods. What would you attribute that major improvement to?
Yeah, Rodney, underpinning that improvement's really been operating discipline and the use of smaller equipment. I think importantly, and as many of your viewers would know, NAL has had a couple of incarnations prior to Sayona taking ownership of the asset. And the obvious question is, well, what's different? Well, one of the key differences on the mining side of things is that we've gone to a very selective approach, which means that we've focused about minimizing dilution and ensuring that we've got very clean contacts between waste and ore. The benefit of this means that we've got less dilution, which means the mill's seeing less waste introduced, which ultimately means that we're getting more ore through the mill. So it's got a number of benefits, and obviously that's it's manifesting in terms of both throughput and also recovery within the mill. So there are a couple of examples, Rodney, of what we're doing differently, but it's certainly down to a very selective approach, which is operating discipline and getting the right sized equipment to be able to enable that.
And it looks like there's definitely potential for further resource expansion from here. Is that fair to say?
Yeah, so we've just actually demobilized the last of the rigs at drilling at NAL. So there's some additional core that will be updating the resource base as well. So we certainly haven't reached the extent of potential at NAL. So again, at 88 million tonnes, we think it's a fantastic resource. And we've now got the opportunity to really study what that looks like in terms of both extension of mine life and also the prospect of being able to expand NAL and increase spodumene concentrate production from NAL.
And then a natural question from there is, how do you see downstream integration, carbonate, anything, beyond just doing the spodumene?
Yeah, so Rodney, I think that's obviously an important point. So if we just go back a step, the government of Quebec and Investment Quebec have made it abundantly clear that they want to see downstream conversion occur in Quebec. And I think beyond that, they actually want to see an entire battery ecosystem developed. I think what has probably shifted a little bit in the last 18 months to 2 years is that obviously as the lithium prices has retreated, that the level of interest from OEMs and so forth is probably moderated somewhat. And so I think the pathway to achieving that downstream conversion is probably a little different to what it might have been 18 months to 2 years ago. I think the other key aspect that we've watched very closely is, particularly in Western Australia, there's been a number of producers that have ventured downstream and looked to import Chinese technology with Chinese partners. It's probably not gone as well as people might have liked, and so we're evaluating this very carefully before we make a step into downstream integration. Clearly, from our perspective, downstream integration makes sense from the perspective that we knock out a whole heap of freight costs that's currently being incurred. So there's an economic rationale to be able to do that. But importantly, for us to be able to hit the go button on that, we've got to have the right technical partner and we've got to get the right financial structure. So we're certainly not going to bet the farm to move into downstream integration. We think that we've got real strengths around discovery, the development and operation of upstream assets. Currently, we don't have that downstream technical capability in-house, so we'd be relying on a third party that we're going to need to partner with. So in short, over the next 6 months, we'll be really refining our approach here, but we are committed to engaging and being involved in downstream conversion. Just the manner in which that occurs, Rodney, is probably a little different to what was contemplated 18 months ago.
Look, that's fair enough, given the world's changing so fast. And then if we look across to Moblan, looks like the mineral resource estimate there has got some upside potential. Can you talk about what's happening there?
Yeah, Moblan just continues to surprise on the upside, and so they're all great and pleasant surprises. We've now got over 93 million tonnes of resource there. I think importantly, what we're seeing is connectivity between the respective pegmatites there as well. So there's some further refinement that's going to be required on the mine planning side of things. But again, we expect that to only improve the optionality that we've got at Moblan. Moblan remains an absolute tier 1 deposit. It's low strip ratio, nice wide intersections, excellent grade. And I think importantly, and probably an area that is probably understated and not well understood, is that Moblan sits at the southern end of the James Bay hub. And so in terms of connection and connectivity with infrastructure and rail, we've got a decided advantage compared to some of those other projects in the area. So, we're very excited about that. And really the next pathway for us on Moblan is completing this drilling, which will make use of that final flow-through share funding this side of Christmas, and then working through what is our permitting pathway to be able to bring Moblan online. So it'll be a modest spend and approach to be able to do that. But importantly, we're going to continue to develop Moblan. We think it's a wonderful deposit and has got the potential to be one of the lowest cost hard rock spodumene producers on the planet.
Yeah, that was a question I was going to ask, is as you do more drilling and more work around that, do you think, that you can see a pathway to better economics there?
Yeah, we certainly think so, Rodney. I think the other component that we're keen to have a look at is just the capital intensity. Obviously, we've done a DFS study on that. Interesting enough, we've seen a number of our competitors come out with sort of relatively comparable studies with sort of a different range of capital intensity. So we'll be keen to have another look, a closer look at that and see what we may be able to do around being able to reduce the capital intensity there. But I think without question, Moblan just continues to surprise on the upside, and we're very excited about the prospects that Moblan's going to be able to deliver moving into the future.
I guess, the obvious lead-on question there is, you have a partner in the project. Your thoughts around potential pathways for funding?
Yeah, well, Investment Quebec, though, they're a terrific partner. They're obviously shoulder to shoulder with us as we're doing this additional drilling. I think, the key thing for us now is working out what the sequence is in terms of the development for Moblan. I think given the size of the resource now, we need to think about how we might sequentially develop Moblan rather than just go as a big bang. And that's obviously something we'll work through with Investment Quebec, and then ultimately they'll make a decision about what their involvement is going to be going forward. So, we think it's a great project. We're certainly very keen. In fact, we'd be quite keen to add to our 60% on that project, but that's something that we'd be working through with Investment Quebec about in due course.
Okay. In connection with this site visit, you put out a new detailed presentation, a link to which we will put in the video description here. But one thing I want to mention is just kind of the timeline and the history of North American Lithium, which has been, it was in production in the 50s. It was supporting, the U.S. nuclear program at the time. But North American Lithium has this. There's a lot of hate, that is thrown at this project based on what Canada Lithium did in, I guess, the 2012 to 14 period, and then again in the last cycle, the CATL was involved. But I think I've had some history with this before. Like Sayona, it came into to purchase it with Piedmont's help. And I remember the Canada Lithium days. That was the Peter Secker, and then I think the Lundin group kind of came in. But that window of time, that the reason Canada Lithium, which came on in the same vintage as Galaxy and Orocobre back in the day, and that was when like kind of Lithium Americas in Argentina and Western Lithium in Nevada, these were all kind of like early stage projects, but the market window of time was really, really small, right? And we're open for a short period of time, and they rushed, right? Everyone was in a rush, but they rushed because it was a brownfield, and they rushed to do an integrated plant, right? They tried to do a mine and a conversion at the same time, whereas all of the other Western Australians and others, they learned from those mistakes. Even Galaxy, kind of nearly went bankrupt because they were integrated. And I think they had to sell off their Chinese mine. So I think it's unfair to like say, oh, it failed. It's a crap mine, back then. And then it failed again when CATL, who really doesn't have any expertise in the market in the last downturn. So it's just important to remind that this is the very first time as a restart that North American Lithium actually, they raised enough capital. They and you'll see in the video, forthcoming, you've put in a lot of all the plant and equipment and crushed ore dome and other problems that were not addressed have been addressed. You're now at nameplate capacity. You are optimizing, but all the drill results and from an ore body perspective, it's gotten quite a bit better. So I just think it's important that this asset is not well understood. And there were a lot of Australian analysts on this trip and fund managers, but in this market downturn, everybody is waiting what supply can come off, right? And there was a little bit of a should this one be turned off because it's not a great mine, and it's a much better mine. It obviously has some freight differential disadvantage going to China because you don't have the localized downstream to sell into. But with that long lead in, my question is, like, Piedmont calls this asset strategic as the only North American spodumene asset, and they have strategic offtake partners in LG and Tesla. And I think it was mentioned in that one of your shipments, has gone to Tesla in one of your filings, but you don't have formal offtake partners, of that type. And you have trading companies. So if you can, I guess, discuss your strategy on offtake, and you mentioned, given that spodumene's in contango, you might be able to lock in something, with a 12 or longer month tenor, that'll enable you to break even. But, what's your strategy on offtake? Good. Discuss that.
Yeah, sure. Thanks, Howard. So I think you made a couple of really key points. That the NAL that we've got today is very different to the NAL of the past. And as you say, some of those key investments around the crushed ore dome is really enabling the production levels that we're now seeing. Coming to the question of how we're thinking about offtake, clearly we need to get our downstream integration and our strategy sort of really mapped out. So we're disinclined to sort of committing to those long-term offtakes until we've got that really nailed, because if there's opportunity for us to be able to get into downstream integration sooner rather than later and knock out that freight component, we're obviously very interested in that. So there's that aspect. We've improved in terms of the trading partners that we've got now. They're able to offer us elements around prepay facilities, and also there's the prospect of being able to lock in some downside price protection, given that the forward curves in contango as well. So there are a couple of the elements that we're able to pull on, and it's very much just around a focus for us of getting through this low price environment and then being well positioned when the market turns to be able to really take advantage of that.
Okay. Could you talk about your relationship with Piedmont and also considerations that you have about possibly expanding production, and or moving downstream into carbonate, given the current, joint venture structure and, the elephant in the room, the offtake, agreement that you have with them?
Sure. So I think everyone's well aware that the offtake agreement with Piedmont sits at 50% of production, or 113,000 tonnes, whichever's the greater. If you think about that against the backdrop of us now having increased the resource base at NAL to 88 million tonnes, and the prospect of, for example, contemplating expansion, clearly Sayona is not going to fund 75% of the capital for 50% of the offtake. We enjoy a great relationship with Keith and the team at Piedmont. So, one of the key aspects for us as we study through that expansion options is to work out, if there's a deal to be done in that space, because ultimately, in some ways, Piedmont's ability or blue sky on NAL is limited if we don't expand, and similarly, our opportunity is also limited. So I'd like to think that there's a way through that, particularly on the back of an expansion case. But we need to do that work, so I don't want to put the cart before the horse there. But look, we enjoy a great relationship with Piedmont, and we just need to work about how we maximise NAL for the benefit of both our shareholders moving forward.
Okay, great. I also noticed that inside Sayona, beyond Moblan and North American Lithium, are other assets in Australia in lithium, but also in gold. Could you talk about those assets, and are there any opportunities to monetize those in any way in case you needed to raise like non-equity capital?
Yeah, Howard, I think right now our immediate focus, we've got a very modest program happening on our Tabba Tabba resource, which obviously sits right along the Wildcat resource discovery. So, we're interested to understand what that is. But given the current environment, we're obviously in a cash preservation environment. So we've got a modest program there, and it's very much focused on Tabba Tabba. We've got a number of other leases. We're not contemplating having to monetize those anytime soon. We think we're in a cash position that we can get through this low price environment, and then once the market's turned and we do the trade off a bit more cash, we'll come back to those other gold tenements and so forth, and have a better look. But for right now, it's outside of Quebec. It's very much on Tabba Tabba and a very modest program.
Lucas, if I just were to ask you, your split in your cash pile that you have, how much is sort of compulsory in the flow through to spend in the ground, and how much is hard money you can deploy elsewhere?
Yeah, Rodney, we closed the June quarter with $91 million Australian at bank. 30 of that is dedicated to flow through share funding, so effectively that was restricted. So left us with a balance of 61 million to open the year. Given the work that we're doing, we expect NAL to be very close to break even through that period. So we think we're in a reasonable position. The opportunity around prepay facilities and so forth to be able to manage timing of vessels and cash flow, we think has got us pretty well positioned. Clearly, in this sort of environment, everyone would love to have more money as bank, but the reality is I think we're in pretty reasonable shape to be able to to get through what is a challenging period.
Okay, thanks a lot for that, Lucas, and also want to thank your colleague Andrew Barber, who I know from Allchem, and I guess I just went to the Arcadium Investor Day last week after the site visit, and they talked a lot about Nemaska, but also a strategic process for their Galaxy asset, which for me is very interesting to see who might become a 49% partner of that. If this is like a Wodgina Albemarle like scenario in the first half of this year, it will demonstrate what something like a Moblan might be worth, which is, I think, is currently undervalued or valued at nothing inside your market cap. But Andrew and yourself, I think it's notable for all of your shareholders to notice there is an increased depth and transparency in your presentations. I think you gave a video presentation after your quarterly webinar, the first of this type, and this video as well. So last thing I'll say is just a reminder to all investors. Obviously we're at or near the bottom, in the lithium space. Equity dilution risk is what is overhanging a lot of shares like Sayona and Piedmont. It's why they're down 60, 70. Arcadium's down 70% this year. But companies that can weather the downturn without having to equity dilute, but also relatively higher cost producers are the ones who have the most leverage to price upside. So if price is going to rise, like Citi is suggesting, 25 to 30% over the next quarter, and Sayona and Piedmont suddenly go from, break even or loss making to suddenly profitable, you fix a 5 times multiple, if they're making 100, each company making $100 margin, on 100,000 tons, that's a 500 million market cap, up from less than 200 million US market cap today. But we don't know if lithium prices are going to rise. We'll see. And is there anything else that you'd like to say, Lucas, before we sign off here?
No, it's been great, Howard and Rodney. It's been great to chat with you. And as you said, we're obviously, very keen to continue to engage with our investors and, and really get through this low price environment and be able to deliver on the back end when prices return.
I remember just one question we always have to ask, James Brown was a very easy, godfather of spodumene to, I feel good, use a rock stock kind of music. But Lucas, I don't know your music taste at all. So like what song or, pop icon is your favorite, or do you think either your favorite or something that represents where Sayona is in its current form that we could use
Howard,
for this video?
I'm a massive AC/DC fan, so our theme will be very much Back in Black.
Excellent. Perfect. All right. I love the non-hesitation at all there. So thank you very much, Lucas, and look forward to publishing this video and seeing Sayona and Piedmont back in black. All right.
Thanks guys.
Again.
Thanks.
See the management team at site. So first, as you see, I'm here, interim general manager for a short period of time just to complete the ramp up and the stabilization phase. So after that, we're going to have a GM in place. Lynn Girard, which you're going to meet today, mill manager. She has been with us since already a year. Her background, she's from the Ontario, so she decided to move from the Côte Gold project to work with us. So she's fluent in French and English, has been working with Newmont, Vale. She's a metallurgist by trade. So end of August, our press release related to the Moblan project, the increase of the resource. So we're up to 93 million tons at 1.21. And what is very important to understand, and we'll discuss more in detail the exploration program today, is that resource has been based on roughly 60,000 meters drilled in 2023. And again, this year we're drilling again an important amount of meters. So good reserve at that level with high grade. And also the NAL Abitibi hub, as you can see right now, 87.9 million tons at 1.13. This is the new resource who has been updated also in August, and we have the 14.1 million coming from OC.
Are there any synergies between Moblan and NAL, or like when you mentioned, like, okay, you're close to 200 million tons, but
yeah.
Shouldn't we be looking at those as just two discrete 100 million ton projects?
Yeah, so it's two discrete projects because the distance between the two projects is almost. Oh, the question was if we can see a synergy between the two assets. Okay, the question is very good. The distance between Moblan and NAL is around 450 kilometers. So to have synergy between, let's say, bringing the ore to NAL, it's a little bit too far, and the operating cost will be quite high. But in terms of synergy, in terms of management, in terms of bringing people back and forth, there is some potential regarding this. So it's not that far. You know, from NAL, you take the road, and in less than 5 hours, you are at site at Moblan. And also in terms of synergy, for sure, the technical experience we're acquiring right now at NAL will be the foundation of Moblan. That is for sure. So it's a no-brainer regarding this. Okay, let's go to slide number, a lot of details. But if you look at the history, there is four major points. NAL has been in operation 4 times. So there is in the 50s. So if we were going back to something like 70 years ago, the mine was underground. Outside, they had the processing plant. They were doing also some carbonate for the US Army. So that site was in operation for roughly 10 years. So we have some pictures from the past. You can look at the gray and white pictures. That was a small town. So that was the plan in the Abitibi region, let's say 70 years ago. Every mine had a small village connected to it. So if we go to 2012, 2014, this is the second time that site was in operation with CATL. So the intent was, no, Canada Lithium, excuse me. So the intent was to start the mine as an open pit, the processing plant, and also do some carbonate at the same time. So those of you who were with us 2 years ago, we discussed about that, the challenge they were facing, the quality of the mine wasn't properly managed. They had a lot of problems, mechanical problems at the processing plant, so the quality of the concentrate wasn't there. And at the same time, they were trying to start the carbonate plant. So everything was quite challenging, and the timing of it wasn't very good, and they were struggling in terms of finance, so they didn't have the money to fix the asset in terms of the processing plant, but also the carbonate plant. So when we're going to go in the carbonate plant today, you're going to see just a legacy of the past. You're going to see all the equipments, but you're going to see they didn't invest all the money. They cut on the concrete foundation and so on. So you're going to see they were really struggling at this time. But the good part with that is, at that phase of the operation, we still have the data and what was the challenge, and now we can learn from that experience. So a couple of years after that, in 2017, CATL restarted this operation. And again, this operation was a little bit different because the approach was just to produce spodumene instead of carbonate. Because the carbonate plant, just to give you an idea, in 2012, 2014, they have been able to produce only 106 tons of carbonate. So it wasn't a success story at all. So in 2017, when they restarted the operation, they have been able to produce roughly 11,000 tons of concentrate per month, averaging 5.6% lithium content and 1.2% iron. But they were having some big difficulties on stabilization, recovery, and availability of the mill. And I will discuss that a little bit later on. So again, some data has been acquired during that time, and us, Sayona, acquiring the site in 2021 and restarting the operation in 2023. So you can see, just to get there and to be able to make that site stable and operate correctly, some tests has been completed previously, 2012, 2017, and with all that knowledge data, we have been able to optimize the operation, which you're going to see today. So to get at the point where we are today, let's say there is 5 years of experiences, tests, and to understand how to produce spodumene and technically understand what is the good recipe regarding this. So he was explaining OCA was connected to NAL to supply ore at a certain period of time. So OCA is 70 kilometers away from the mine. As we speak, there is no operation ongoing at OCA because at NAL we have sufficient ore, so it's just postponed a little bit later on. In terms of resource, like I said, 87.9 million tons at 1.13. The financial year 2025 budget, the guidance is in between of 190 to 210,000 tons of spodumene, targeting 5.4 and 1.2% FT. Also, as you all know, we have a Sayona partnership with Timo at 0.5%. Can you repeat your question, please?
What's the earliest time to start the mining at the Lithium project?
We have been able to, with the infill drilling, we have been reconfirming some inferred, which are in our merger and indicated categories. So that is giving us some time. Okay, on slide 13.
So on the costs, so given production guidance, how do we think about unit costs versus the last quarter?
So the question is the guidance for financial year is in between 70 or?
Sorry, so it's 700 to what?
Yeah, to 850 US dollar. Yeah.
Free on board.
Yep. Good. Okay, so for the infrastructure, what you see there on slide 13 is the global final stage, let's say, of the operation. So starting from the far right, you can see the open pit, the final design from the DFS 2023. If you look at the top, there is the waste stockpile number 2, which is in operation right now since the beginning of the month. I think Lucas explained that previously. When we started the operation, we were using the waste stockpile number 3 on the far left. Because we didn't have the permit for waste stockpile number 2, so we had to use the waste stockpile number 3, which is 50% further than the waste stockpile number 2. Stopes, all the challenge with the geotechnical limit, which I discussed in the bus. So how many engineers you have working on the geotech limit as we speak?
Tech and engineers were 20. I think we have 20.
20, so lots of people and brains just to make sure we have the proper plan, the geotechnic and the mining plan at the same time. So what we're going to do, we're going to go in the van and we have the most important person, the mine manager, Philippe Chabot.
Nice with you.
So Philippe is the VP of mining, but also he's doing the mine manager by interim. So like I explained in the bus, he has a lot of experience in open pit, managing huge like ArcelorMittal and iron ore projects. So has been working with us since already 2 years. It's on employee number 2, I think, or something like that. We started at the same time. So Philippe and I, we have been working together in many places in Canada and also in Africa. So when it's time to optimize a mine, Phil has a lot of knowledge with his team member. So let's go.
Dilution down.
Yep.
Can you talk us through that?
Yeah, so because Philip and the rest of the team is doing a great job right now of managing dilution. So because with the ore sorters, it's great technology, but what we have in place right now, it's the optical sorters. So when it's raining and the material is getting, let's say, gray, it's not super efficient. So because we're controlling the dilution quite well, we can process that material. We bypass the ore sorting, and after that, just a final touch-up to have the QA/QC in the iron content quite good. We just recover the iron with the WIMS and the limbs. So we have that optionality. So the 3 phases, super important. Good mining, we control dilution in the pit. That is the most important one, okay? So Philip and his team are focusing on that, and that's why we have the geologists 24 hours per day at site, in the pit, flagging the veins, 7 days a week. After that, we segregate the material on the ROM pad, different type of lithium content and also the Fe content. After that, we can use the ore sorters if we need to. And finally, for the final QA/QC to have a good iron content in the concentrate, you have the limbs like I explained, recuperating the particles from the grinding media, and after that the two WIMs, which can we play with the intensity and we can have some very low iron content. So all of that together is giving us what you saw, because the feed of the iron content is higher, because when they were operating only in the phase 1, they were mostly in the granodiorite. Right now we have a mix of the phase 1, phase 2, and phase 3, so the iron feed is higher, but because we control the dilution, because we have the ore sorter, because we have the limbs and the WIMs, we can create some very good quality at a higher throughput.
How much high iron ore are you stockpiling now that you're not putting into the plant?
Yeah, if we have, let's say, some highly diluted material, we have a specific stockpile for that.
How much are you stockpiling?
As we speak right now, we have roughly 400,000 tons, but there is some stockpile from the past also. Okay, so 400,000 tons of material stockpile there, and as soon as we can, let's say, develop technology with ore sorters or other approach to reprocess that material, it's going to be feasible. Yeah. It's a good question. Other questions?
You can see there are quite a few rafts of granodiorite in the pegmatite. Is that just characteristics at the margins here, or do you see that, you know, these rafts of the volcanic and the granodiorite within the pegmatite, and that creates that internal dilution or the contamination?
Exactly. So depends how the blast is reacting. Sometimes you can see that there is a pocket of, let's say, granodiorite. So depends how the blast movement is at the end of the day and how the operator is able to select that material. Sometimes we process it, or sometimes we're able to extract it before. So it depends case by case. The best case scenario, let's remove it. Okay, this is the best case scenario, but sometimes it's going to cost more to remove that material instead of processing it. And we just adjust the WIM's intensity at that time. Yeah.
And on the resource model, 2 meter higher is reserve, and less than 2 meter is waste.
Smaller veins,
that material. But sometimes you are able to segregate on the field, and you gain your depth. 2 meter approximately. The dike Spodumene.
For sure, with the volcanic rock, because there is more Fe, probably the jet GET consumable will be higher, because you know it's more abrasive. But in terms of total performance, we don't see any performance difference regarding this. Oh yeah. Oh yeah. Because globally the material is quite abrasive. Okay, so mostly because the volcanic iron has the higher Fe content, but there is some also in the granodiorite. So it's.
In terms of structural competency, just like a little bit of loose material on some of those benches there, is that just from natural wear? Or?
No, it's because we blasted. You see right now,
that is just on the back of
exactly,
the blast.
Exactly, because this is where we're mining for the next 2 years. So that's why we have that kind of material. But if you look at the rest of the walls, they're very solid rock. We have no fault in the deposit. So usually you can have a couple faults, which can create some issues. But here, absolutely no fault. We're on the top of a hill, so it's a mountain, so it's solid rock. No issues regarding this.
So touching any of these sections or leaving, so that, like, is that ore going through there? But
it's just a small, that's it. So what we see the future of the mining is we're almost at the final position of phase 1, so we're going to be really pushing this way, phase 2, phase 3 for the next 20 years, because this is the life of mine, 20 years. So for 20 years, phase 3, phase 4, and phase 5.
Will you push it back beyond the tree line over there, or does this go kind of out to there?
Well, it's going to go just before the laydown of Fournier. You saw that, where there is the infrastructures of the mining contractor. It's going to go right there. Yeah.
And just in terms of grade control, I guess at the bottom of the pit, is it, you were saying flagging the dikes, is it a fairly easy process? Is it based on visuals, or is it more?
Well, we have the blasting holes first. We test for the grade, okay? And after that, when we blast, we have some ore pro, which is you're blasting and you know what's going to be the reaction of your simulation. So yes, we have the human interaction flagging the veins, but also what we're doing right now, we're installing some GPS in the excavators, okay? So to be more accurate in the future, we're going to be able to say, okay, this is what you're going to follow that vein or something like that. So we're getting there. you know, we are a young business and we have to develop everything and put in place. So we are in the fun phase of optimization as we speak and optimize our operating costs. So this is what we're looking for.
Looks like the last couple of months you've obviously stepped up your performance from a processing perspective. Is there still things that you think you can do to continue to improve that, or is that where you think you just want to get stable at?
It's just the beginning of the continuous improvement, because we have a long list of projects, and like we explained, I was discussing with Greg in the bus this morning. It's you know, because we're now getting very stable. For the last 6 months, we have been able to produce, you know, constantly the baseline of the nameplate of the mill. So we can do with that information, build the algorithm of what is the best recovery, what is the best throughput, and so on. Because when you don't have some data and the mill is stopping back and forth every 2-3 days, you know, you just have to focus on availability and utilization. So the last 6 months, we have been able to produce 40,000 tons, 49,000 tons, and I'm talking about quarters, and this quarter also we're on par. So now we know what we have to do. It's just time to execute, implement, and put the technology in place.
What do you think that steady state utilization is?
That's
into the 90s,
you have to come back, let's say in 6 months. Let's say in 6 months. Because there is lots of stuff we're testing right now, but in 6 months from now, we're going to be able to see what is the, let's say the final throughput. But that's about chance. It's not complicated in mining, it's all about the throughput. More tons you produce, you decrease, it's not rocket science, but if we need to figure out what are the bottlenecks at the processing plant, what can we improve in terms of, let's say, pumping capacity, piping design, because we have a legacy of 2010, don't forget that. So every time we're figuring out a new bottleneck, we put a plan together, we put the capital, we fix it, and let's go to the next one. So.
How does adding, you know, all of these new pieces of equipment, which obviously improve processing performance, but sustaining capital with all the extra equipment that you now have to maintain, I mean, does that materially
it's not that much.
You say?
No, it's not that much. It's mostly, you know, with the C150, it's liners. It's not piece of equipment which are very expensive to mine. You know, so it's not. We don't see a huge increase in the sustaining capital.
Type pieces where you can replace them.
That's right. And there is some project of changing the type of liners, how we can increase life of every liners. So it's just normal operation. Yep. Now, and this year, you know, in terms of capex, we're not spending a lot of money because we're just pushing and producing. So we have some smaller project, but not that much. So we have the TSF number 1, and the rest is update at the processing plant, but nothing to compare, just like financial year 2024.
If you get the TSF height, like how much extra height do you think you can get, and do you need to permit that extra height?
Yeah, well, that is a very good question, because like I said in the bus, we have a solid ground, so there is a study ongoing right now how high we can go, because it's super easy to maintain this type of wet tailings. So instead of co-disposition, if there is the possibility to go on this aspect, we just need to complete the study.
And does that push out TSF2 then? So instead of 2030, maybe 2035?
Exactly. So it's always to optimize what the asset you have in place. So, because wet tailings, when you have a solid base, and we have some solid rocks here, so it's not an issue. You know, we're not on clay or something like that. So I'm hoping the study will give us some potential upside regarding this. Yeah, it's a good question. Yeah. Because it's always that, man, the waste dump and the TSF. Huge cost.
They're not cheap.
No.
Metallurgy, about 16 years experience in the mining industry. Basically, you've been part of some greenfield scoping studies, operational readiness, ramp up and operations. So that's a high-level summary.
And we had a chance to work together at Côte Gold with IAMGOLD a couple of years ago. So when we started the operation here, and we had a discussion, Lynn and I, and she was really open to move from Ontario to here in Quebec to do that project. So it's a full commitment. She moved her family to the beautiful town of Val-d'Or, so from Timmins to here. So it's a full commitment. So she's very good. And we have Monsieur Charles Brousseau.
Nice to meet you, everyone. I'm Charles Brousseau. I'm a metallurgist superintendent here for NAL. I've been with the company for 2 years now. Previously, I was a metallurgist for copper smelter nearby in Rwanda for Glencore. So now I started here as metallurgist, and I moved to a superintendent position, working for the commissioning, then the ramp up, and also important projects that we have implemented throughout the ramping up of the production.
So all the questions you got about recovery optionality, so Charles is dreaming about that every single night. Okay, what can we do? So, and it's related to his bonus. It's just a joke, but you know, at the end of the day, Charles has been very involved of testing new collectors, the TK57, the TK59. So with his team, very dynamic to find some opportunities, because there is always some opportunities in a processing plant, but you need some smart people who think about that all the time. So Charles, under the management of Lynn, they are unlocking the full potential of the site. Like you said, do we have some other opportunities? Yes. What is the final recovery? We're not going to commit on this today, but we have on the budget the 69-70%. But we're really hoping Lynn and Charles will surprise us with their little projects they are working on. But that's going to be in the next site visit and not today. Good.
So we're here in our grinding circuit where you can see our rod and ball mill. Moving on to our desliming and attrition circuit. And then over to the right, you can see our low intensity magnetic separator along with our 2 wet high intensity magnetic separators. So this is really where the iron removal for quality concentrate occurs. In the distance there, you can see our stack sizer screens, which is part of our grinding circuit. And then finally our flotation circuit. So fairly standard flotation, conditioning tanks, rougher scavengers, as well as 3 stages of cleaning. Then our final concentrate, which you can see on our filter belt here, where we remove humidity in preparation for transportation. You can see here the color of the concentrate material, really a good indication of the quality of our final product. And this is the material. This is the end game here, where we take the material and then ship it out to further downstream processing.
All right, I'm here with Andrew Harrington at Petra Capital, right?
Correct.
Analyst. I met you here 2 years ago on the Piedmont Sayona visit. And between then and now, Petra raised, I don't know, like $200 million for Sayona?
Yes.
At what price? Do you remember?
18 cents.
18 cents. And I remember like the market gave Sayona a lot of flack for having done that at the time. Like, one, who's Petra Capital? I didn't know.
Yeah.
2, like, why they raised so much money. But I think in hindsight, everyone will agree that that was a good idea. You're on the sell side as an analyst, right, for Petra. So
correct.
What are your thoughts, on what you've seen here since the last time, and just overall takeaways from the site visit and thoughts on Sayona, and any color on the broader lithium markets and valuation?
Okay, that's all. Okay, let's see. Let's begin. Touching on your question or your statement on the 200 million, we're always advising companies, if there's money available, to take it. MDs and chairmen are always worried about dilution, and that's fair enough. But if the market is willing to give you money to keep developing your project or to take it further, you should take it. I think that's a very basic thing that people should look out for. On today's site visit, very impressed with the level of progress. I mean, I've been there twice now. I can see there's been a lot of work on the detail of the roadways, the water diversion. I can see the plant is running, it's humming. There seems to be a lot of material available for them. We didn't go through the stockpiles. Actually, we didn't have that chance today. I wanted to see how that's looking inside the ore dome. I don't know why we didn't see that, but I would have liked to. I was very impressed with Sylvain, the new COO of NAL, which is the operating subsidiary of Sayona in Quebec. I think really the key question is cash now. Surviving through this trough period will be the key question I think a lot of the people on the site visit will have had. Can they survive? Are they running at a loss? How long can you run at a loss for? Having that cash buffer helps them, as we now that they have it in their bank. But we need more facilities, more operations to cut back operations. I think the way the price is running in lithium at the moment, not a lot of people are making money that aren't, say, Pilbara or Greenbushes. And Greenbushes are acting like a marginal player sometimes, on and off. They've just come back on. Everyone's talking about cutbacks at the same time as some people are talking about further expansions. Even Sayona today is talking about expansions and how do they recut the pie with Piedmont. So looks like the long-term view is still people need more lithium. It's just this very short-term period where the price is very low. And that's the key question. How long can everyone hold on? And I would have thought someone like CATL could hold its breath longer than someone in a quarterly reporting requirement situation like Sayona or IGO or PLS. But no, looks like they needed to come up for air. They couldn't hold their breath at these prices for as long as some of these companies over here.
It's a very interesting dynamic. I mean, I've had an opportunity to speak today to people at UBS, at Goldman, yourself, BMO, and the CATL cuts do seem real. There's still a question mark. Is it the 72 or 75,000 per year, or is it only like a third of that?
And how quickly they can come back?
Can they come back, and at what price could they come back? I mean,
yeah.
One takeaway was that the floor might be 700, but they might come back at 1,000 or 1,200. If that's the case, that's not enough. North American Lithium, I think, could do well, at 1,000 or 1,200. They can wash their face. But interesting comment that Lucas made is, look, the market's in contango, at least, and you could sell forward, at least for kind of a year. So it'd be interesting to see if Sayona or Piedmont or anyone else can kind of take advantage of these, the very rapid evolutions in the forwards market. There's been a lot of liquidity.
Yeah.
And if you could
the CME
at a higher price, if it's on the CME or if it's with a trader or over the counter, or I don't know, but just interesting to watch. But I was very impressed just to see it kind of like now in operation. 2 years ago, Brett Lynch was here and was telling us like what they were going to do. Then they had James Brown as interim, and Lucas, I just met him, but he's been in the seat for only 6 weeks. But
10 weeks. Yeah.
Very impressed, and I agree with you on Sylvain. And there's a lot of the conversation today was like optimize. They've ramped up. The recoveries are good.
Yeah.
But they're confronting a very low price with a transport cost, disadvantage. That's fundamentally the short-term issue they confront. But I think like the negative overhang about this deposit, about this Quebec curse, I think that they're doing a lot to kind of like put that in the rearview mirror.
Correct.
And I hope that's not lost on people who are here and who are observing the company, that they're addressing all of the issues that weren't addressed in the previous times that this mine was sought to be built, right? Because the markets was just very immature then, and they didn't have a big enough window. But they have made all of the investments, and they have thought this through, and they have a cash buffer. There's no debt at the company, so the stock, I don't know, it's less than 200 million US market cap.
Yeah.
They got Moblan as a standalone company, would have probably as big or bigger market cap than that, even with their only with a 60% interest, in my opinion. But there's this equity dilution worry, overhang, that is under play.
Yeah, some instos that I would speak to, and like institutional investors, their first question would be, when's it going on care and maintenance? For the last 6 months, that's the question. I'd call them up and say, look, this is what's happening with Sayona, blah, blah, like it because of this, these are the issues. And they'd be like, don't want to hear it. When's it going to go on care and maintenance? I'm like,
because it's the high cost producer, you would think. But it's not so easy if you're a single asset company. Turning things off has a big cost, and then turning it back on has a big cost.
Exactly.
So it's a rational decision for them to kind of like weather the short term.
Yeah, with no debt and lots of cash, you weather the downturn. And we know how sharp these turns can be. And we saw the reaction in the share prices last week with the the news from CATL, suddenly everything was up 15% for 2 days in a row.
Yeah.
And now we're trying to see how real it is. Is there somebody else to follow? What's going to happen? You know, these short positions also really magnify these moves.
Yeah.
And like you say, Moblan gets no credit in the market cap. They've got $400 or $500 million in invested capital at NAL, and the market cap is half that.
Yeah.
So at some point that gets recognized. At some point NAL gets recognized, and that's a you know, very positive move that these guys could enjoy.
It's complicated by the Piedmont offtake economics.
Yes.
But I mean, an important thing to recognize is that actually the high cost producers are the most leveraged to the price upside. So like, you know, Pilbara has upside, obviously short covering, you know, but that's a kind of low beta way to play rising spodumene prices. A high beta play is Sayona and Piedmont.
You're on repeating my thesis. If you want to get on lithium thesis, when the price turns in the commodity, the first equity to run hard will be Pilbara. The second will probably be Sayona. That's the one with the low margin right now.
All right, Lucas, we just finished the visit to the mine and the plant. We're going to do a proper interview with you, I guess, in the next day or two. But we're here, I guess, how long ago did you join Sayona as CEO?
So it came on in July, so at the start of July, so just had the feet under the desk, probably about 10 weeks now.
10 weeks, okay. And what's your background?
So mining engineer by training, 25 plus years in the industry, worked across a heap of different geographies and commodities, across copper, silver, lead, zinc, manganese, met coal, thermal coal, also had a bit of exposure to gold, platinum and some tin as well, and some bauxite. So, you know, it's against that breadth of experience that, you know, I'm really excited about the opportunity we've got here with Sayona and in particular at NAL.
Yeah, so I was here 2 years ago and I watched, we've been involved with Piedmont for quite some time, so I watched, you know, the whole process of Sayona being bought. Brett Lynch did a fantastic job, you know, throughout COVID, conceiving, you know, the purchase of that. But then my old friend James Brown came in, you know, interim CEO from 2 years ago. It wasn't even an operation. We were on the site visit here, and they were telling us what they were going to do. We've now taken a lot of footage of what, you know, you're at basically full capacity or close. I mean, it's still some things to optimize, but the skill set from here, right, to manage an operation, especially kind of like in a downturn. So what from your experience in prior commodities, right, you know, in tough times like this, as an operator, right, because this is something, you know.
Yeah, we're in the operational phase right now.
Exactly.
Absolutely.
You know, there's some market, you know, worry like things are going to shut down, not shut down. You've said you're going to, you know, continue, you know, onward here. So what could you, I guess, from your experience, share with us through the cycles to give confidence that, you know, we'll see the other side of this in a very profitable way.
Yeah, so Howard, obviously I'm new to lithium, but I've, you know, been through a ton of these cycles before in different commodities. So, you know, the opportunity that we've got now is we're going to continue to shake out a lot of costs, continue to drive our volume up. So our focus at NAL is very much around the safe delivery of volume and reducing our unit costs. So there's a number of factors. I mean, you would have heard today from Lynn Gerard and Sylvain Collard that, you know, the efforts that we've got going on in the mill around optimization there, the work that Philip Chabot and the mining team are doing as well to be able to, that selective mining, to be able to reduce dilution to ensure that we're really maximising the volume that we're getting into the mill. So it's very much a case now of us focusing on those efficiencies and being able to drive that volume up through in terms of spodumene concentrate production and driving our unit costs down. We're also looking at opportunities that we've got on the logistics side. So, you know, we're really leaving no stone unturned. And our strategy through this process is we're going to get a unit cost down, effectively get ourselves into a pretty good position to be able to ride this storm out, and then we'll be perfectly positioned once the market turns, and it's going to turn, to really be able to throw off a lot of cash here at NAL.